In this short video, we're going to use demand and supply theory to explain a rise in the price of quinoa. Here's the problem. The price has in fact risen threefold since 2006, and the quotations suggest that this has been caused by a change in demand for the product. And theoretically, we would argue that this is causes a shift to the right of the demand curve due to a change in preferences or tastes. On the other hand, the quotation also alludes to a change in supply conditions, and we now want to clarify whether this means a movement along a supply curve or a shift of the curve. Now, talk of curves immediately implies a graph. So we should look at the market for quinoa using a graph. In this graph, we start off with the equilibrium price set at PE by the intersection of the demand curve here, D, and the supply curve, S, and the intersection takes place at A, so that the market sells or trades QE, quantity tons, 0 QE, at a market price of OPE. Now, the article suggests that there's a shift in demand which helps us explain the rise in price from PE to PE prime through a change in tastes. So that these green arrows here represent a shift to the right of the demand curve. Notice that the implication is that there is an increase in demand irrespective of the price. At each and every price there's greater demand. Now, it's informative to look at the processes whereby this price rise takes place. At the existing price, PE, or the initial price, PE, the demand is B, and the supply, the quantity supplied, is A, or Q1 and QE. So the quantity of excess demand is the distance AB. And AB, excess demand, creates a rise in the quantity demanded as the price, a fall in the quantity demanded, not a rise, a fall in the quantity demanded, a rise in the quantity supplied, but a fall in the quantity demanded, because people get crowded out of the market. They drop out of the market as the price gets higher. So some people find the product too expensive and they stop buying it. So in aggregate, less and less people buy it at the higher price. On the other hand, producers are induced by profit making to supply more. Now, in the short run, there isn't a lot of flexibility to supply more because existing suppliers don't have the capacity. However, they may buy in from other suppliers and move to the market. Some suppliers may sell in different markets. They may even transport quinoa from other markets in order to raise the quantity supplied. But anyway, there is an inducement to supply more. And as more is supplied, less is demanded. Eventually, there will be an equilibrium at QE prime and a price of PE prime, and the point of equilibrium becomes point C on this graph. Now, what happens if by an increase in supply, we don't just mean a movement along the supply curve induced by a desire for profitability, but also a longer term reaction by producers to increase the supply because they have moved out of some other production, some other grain product, and they've realized that the price of quinoa is rising, so they move out of a product that has a relatively lower price and go to produce quinoa. So now, as that happens, of course, that shifts the supply curve to the right. So we now have this idea that it's not just the quantity supplied that changes, but also the supply. We use these terms quite differently in microeconomics. So the supply curve shifts from S to S prime. There is still excess demand driving price up, but in this case it doesn't drive it up quite as high because the supply is augmented by new suppliers entering the market. Now that's a change in the ceteris paribus conditions of supply, and one important one will be expectations of market conditions in the future tends to make people switch, or farmers switch from one kind of production to another. Notice that these quantities here that the market eventually clears at from QE to QE double prime imply a change in resource allocation. People are moving out of one kind of grain into another one. And there may be some specialist knowledge and other things that need to be made, to be used in those circumstances. So what's the moral of this video? Well, firstly, graphs force us to focus on the definitions. We have to understand what quantity means, price means, etc. We also have to be aware of what variables could be impactful on the market in question. We also were forced to think about how it is the price moves up to the new equilibrium. In other words, we were interested in the processes, the human behaviors that were implied. On the one hand, consumers are being self-interested and not wanting to get the best deal, and suppliers on the other hand wishing to make profits as the underlying motivation. And then we came up with some potential outcomes regarding the actual level of price as well as the quantities of resources needed to produce the new market outcomes. We also highlighted the distinction between a change in the quantity demanded supplied, which are price-induced. In other words, we talked about a movement along curves, and distinguished this from demand and supply as shifts of curves, which are caused by changes in the ceteris paribus conditions. And so that's often very important for us to be able to ascertain. And finally, it's underlined the fact that price and quantity outcomes in the real world are often the results of shifts in both demand and supply conditions, as well as changes in prices. And graphs are useful in focusing our minds on which are important, which are not important. A very illustrative example is the current change in world oil conditions, which impact directly on the price that we are paying for petrol at the bowser. Some of that is created by supply conditions. The changing supply conditions in the world are created by fracking in the United States. But also some of it is because demand has changed as a consequence of world growth factors.